Good. Well, hey, I just want to start out by reading some of the description for TPLC, which is one of the ETFs that's on it's out there on the internet. You can go to the timothyplan.com and you can read this for yourself. But the description says market decline is measured by reference to the Victory US Large Mid Cap Volatility Weighted BRI Index, which is comprised of the same securities in the index, but without any allocation to cash. And during a period of significant market decline, which I would say is what's happening right now, which is defined as a decline of 10% or more from the references index's all-time daily high closing value, the index's exposure to the market may be as low as 25%, depending on the magnitude and duration of such decline. Well, that was a mouthful, right? So tell us again in very simple kindergarten style terms what this strategy actually does.
Well, thank you, Shanna, for that and for reading that. We probably should read the disclosures by compliance as well. So, actually, when we think about investing money, we think about gaining money. Everybody always wants to make money. So, if we want to make money, how do we make it in times when things are ugly? And I think it was John Templeton who once said, people lose more money trying to avoid a bear market than actually participating in one. So if that's the case, a bear market being one where the markets go south or go down, how do we protect ourselves? And when we built these methodologies, which are the very first strategic beta BRI ETFs in the industry, and when I say strategic beta, I know that's a fancy word and terminology, but what it really means is doing something other than capitalization weighting, which is what the S&P does. Capitalization weighting simply means the largest company in the industry or in the universe has the largest position in the portfolio. For example, 30%, over 30% of the S&P is represented by 10 companies. That is way overdone. It has too much sector risk, which is mostly technology, and too much concentration risk. So what we've done at Timothy are to build investments that are weighted differently. Weighted simply means how do you give the weight of a company in a portfolio. If you equal weight, you give everyone the same position in a portfolio. We volatility weight, which simply means the more volatile the stock, the smaller the position. The more conservative the stock or less volatile, the higher the position. And what we've found over time is that over the last 40 years that we've tested this, but over the last 22 years that we've actually had it available, volatility weighting has more than doubled the performance of the S&P. So we took that methodology and we added a BRI screen 3 years ago. So our ETFs are now 3 years old, effective May 1st. So we just had a birthday. We're very excited about that. But one of the things that we wanted to do was not only volatility weight to help people have less risk, we wanted to provide also a methodology of going to cash when markets get real ugly. So to give you an example, in March of 2020, when the pandemic hit, it took a big hit in March and February. It was when it began. So March 1st, we went to 75% treasuries. And April 1st, let me look at these dates here. On April 1st, it had declined more than 20%, so we went back in, part of it, 50-50. And then on August 1st, we went 100% back in. What it simply says is that when the markets decline, Warren Buffett says, buy when there's blood in the streets. But how many of us are brave enough to do that? So we built a methodology that protects on the downside by going to treasuries when markets decline. And as they continue to get deeper in their decline, we add money from the treasury bills back into the stock market. And what happens when you buy when the market is really down? When it goes up, it explodes on the upside because you bought really cheap securities.
That's
So we
great. That
do
makes a
that.
whole lot of sense. I like the point that you make that 30% of the S&P is made as just 10 companies. So when we're listening to the headlines every day, and now today we know that the S&P is down, 14%, the Nasdaq is down 24%, and lots of times investors will hear the news and they will think that, well, if the market's doing that, my portfolio must be doing that, right? But the whole point of using things like this, the fact sheet for TPLC says that, it seeks to outpace the major indices with reduced volatility. So you just gave a great explanation of how that happens because beta, is just a fancy word for volatility. And I think what most people, in my career and talking to people, what do you want to see happen? And, what kind of return do you want to see? Well, I heard the market's average 10 to 12%. So, I'd be good with 9. And then you say, well, what kind of volatility are you comfortable with? Like, at what point would you need to get out if you saw downside volatility? Oh, well, I mean, I could maybe handle 5 or 10%, but those two things don't really jive together, do they?
That's correct. I mean, anytime you see when you participate in an equity market or the stock market, you have to be able to anticipate that that stock market has a probability of about 80% that it will hit a negative 20 at some point over the next 5 to 7 years. It's going to do that. So what we do in these long cash strategies is protect in those major declines. Example, this year, our high dividend strategy is down about 5% from its peak. So when you talk about the S&P and others being down like 14% for the year, our high dividend's down 5, and it hasn't triggered to go to 75% treasury bills yet, simply because of the quality of those companies that are biblically screened and the quality of those companies based on their earnings. In our large cap space, that did trigger this past month. So in May 1st, it went to 75% treasuries to protect on the further declines. So it was down a little over 10%, and it went to 75% treasuries. So if, for example, the market would decline another 10, the client is going to decline approximately 2.5 because they only have 25% of their money invested. So it gives
And
great protection on the downside.
Yep. And that is the key point there. It's all about, in real estate, they say it's all about location, location, location. Well, investing, it's all about allocation, 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 right? So we're not
Alec,
allocated like the market is. We're
you know,
allocated to protect from, downside volatility. So,
allocation is a critical point. Allocation is very important. Timing can be important too. So people will say it's not timing of the market that counts, it's time in the market.
right.
That old adage is true if a person has the capacity to last 20 or 30 years or stay in the market for a long period of time. But what about those people like myself who are semi-retired and they don't want to see major declines? They look toward these long cash strategies. And the one thing that I'll point out is that we can go to cash and it's a non-taxable event for us. Our ETFs, when they move money in and out or reposition or reallocate or reconstitute every March and September in order to make sure we still have high quality basket of securities, it's a non-taxable event. Now we've
That's a
seen
great
some
point.
ETFs out there distribute large cap gains. I don't understand why. If it's done properly, you shouldn't have to do that. So
That's a
it
great
does
point.
provide.
Because if you were just managing your own portfolio and maybe it was mutual funds, stocks, or ETFs, or whatever it might be, if you just went 75% cash on May 1st, you are likely looking at some pretty decent capital gains tax coming up because the markets just have done so well over the last few years. But inside an ETF, you don't have that same tax consideration to worry about.